Hello viewers, welcome back to Studies. In this video, we will discuss the differences between financial accounting and management accounting. One of the differences of financial accounting and management accounting is that financial accounting is well developed and a very old system that is in practice, whereas in case of management accounting, it is of recent development. So financial accounting can be traced back to the times when the business started. That those were the times when the books of accounts were definitely maintained by the business owners, but then it was a very crude system. The field of financial accounting started evolving and it started becoming more systematic, and a solid system was put into place during the time frame of 1812 to 1920s. So this was the time frame when financial accounting evolved as a solid system that is in place even till date. Whereas when it comes to management accounting, it is of recent development in the sense the field of management accounting started getting prominence or started getting importance only during the 1950s. So from 1950s to around 1980s or 80s, 1980s or 1990s, that was the time frame when management accounting evolved. Okay, as such, management accounting is of recent development, whereas financial accounting has been there for more than 200 years. Another difference between financial accounting and management accounting is that financial accounting deals with the business transactions and events for the enterprise as a whole. That means to say, at the end of the financial year, when financial reports are prepared, that is trading and profit and loss account and balance sheet, uh, all the transactions related to the business for this particular time frame for this 1 year is being prepared, is being mentioned in the trading and profit and loss account and balance sheet as in the summary form. Whereas when it comes to management accounting, in addition to dealing with the business transactions and events for the enterprise as a whole, it also takes organization in its various units and segments. So, management accounting reports can be prepared segment wise as well. Either it can be prepared for small units of the business. You can, like for example, it can be functional departments. You can prepare management reports. For a production department, or it can be prepared for exclusively for a purchase department or for sales department or for marketing department. So unit wise or segment wise also you can prepare the management reports, management accounting reports, whereas when it comes to financial accounting, it is a summary form. Okay, for the whole financial year, whatever transactions the business has transacted, everything makes its way into financial accounting in totality. The next difference between financial accounting and management accounting is that financial accounting reveals the overall performance and position of the enterprise. So, at the end of the financial year, when financial reports are prepared, you get to know whether the business has earned profits or whether it has incurred losses, and where exactly the what exactly is the financial position of the business by referring to the balance sheet. When it comes to management accounting, the is on the details of operational costs, inventories, products, and process. So, minute information exclusively which is prepared for the use of the management is the main focus of management accounting. Now, this is something which is similar to cost accounting, where management accounting prepares all these detailed reports, maybe operational cost wise, or it can be the reports relating to the inventories, it can be a report relating to the sales, it can be a report relating to the product or the process. This is prepared exclusively for the management to take up decisions. One of the difference between One of the differences between financial accounting and management accounting is that financial accounting is attached more with reporting the results of the business as well as the position of the business to persons and authorities other than management. So, when we look into the financial accounting, it caters to the requirements of the stakeholders at large. People who are interested in the business, whether they are internal to the business or whether they are external to the business. Results are projected in the profit and loss account of the business, whereas if you want to look into the financial standing or financial position of the business, one of the financial accounting records that we need to refer to is the balance sheet. Okay, as such, financial accounting caters to the stakeholders at large, and it reports the results and the financial position of the business. When it comes to management accounting, it is concerned with generating information for the use of internal management. Okay, so management accounting, the main focus is to provide the required data to the management so that they can take effective and timely decisions. Moving to the next difference, financial accounting is necessarily historical in nature. That means to say, as and when the business transactions happen, it is recorded in the books of accounts. Okay, so as such, financial accounting is historical. It is past record. The data is already entered into as and when it happens. When it comes to management accounting, it takes the form of analysis. So whatever data is recorded as the events happen, business transactions happen, the data is analyzed, and it is not just analyzing the already recorded data, but also it gives importance to estimations. Okay, so it anticipates such events for the future. So estimations are also made when it comes to management accounting. Such estimations become a part of management accounting. But when it comes to financial accounting, it is post-mortem. Data is already entered into in the books of accounts as and when it happens. You cannot do much or except for the fact that you refer back for the data. Whereas in case of management accounting, the recorded data provided by financial accounting is dissected, analyzed, brought meanings into it so that decisions can be taken. And definitely, it also gives scope for anticipating the future requirements of the business. When it comes to financial accounting, it is more precise than the management accounting data. The reason is it is precise because the data has already happened. Okay, it is historical. As such, it is precise. What has happened is recorded. When it comes to management accounting, it generally reflects the expected future and hence could only be an estimation. Management accounting, as I told you, it is an estimation. Now, estimations are nothing but projections, right? And if you want to make the projections, you get the data from the financial accounting. So the data regarding financial accounts is taken by the management accounting system, and projections for the future are made. Another difference is financial accounting results are reported on a year to year basis. That means to say every financial year, at the end of the financial year, accounting reports are prepared. But when it comes to management accounting, since it caters to the requirements of the management, it can be prepared as early as weekly, or it can be prepared fortnightly, or monthly, or bi monthly, or once in 6 months the reports can be prepared. So there is no hard and fast rule that management accounting should cater to the specified time frame. As such, it is left entirely to the requirements of the management. Whenever they require it, the reports are prepared. Financial accounting has to be governed by the generally accepted accounting principles. So you have set principles and concepts and conventions that has to be strictly followed while preparing the financial accounting reports. Whereas when it comes to management accounting, there is no hard and fast rule, okay, because it is not mandated by any of the laws. As such, management accounting is free to formulate its own rules, procedures, and forms because the information it generates is solely for the internal consumption. As such, the way the management asks for the reports, it is prepared in that manner. So there is no hard and fast rule that it has to stick to a particular format or certain rules and procedures need. I mean, there is no question of some rules and procedures to be followed when it comes to management accounting. Generally accepted principles of financial accounting will not permit the company to prepare the accounts as per their whims and fancy, right? So it has got a certain set of rules, procedures that has to be followed when financial accounting reports are prepared. As such, preparation of financial accounts is strictly based as per the specified requirements. Whereas when it comes to management accounting, what is important in case of management accounting is the usefulness of the information for the managerial functions rather than its general acceptability. Since it is for internal use only, internal use of the business, management accounting need not follow any set conventions or procedures. Okay, it is left to the management as to how the reports needs to be prepared. Financial accounting is mandatory in case of joint stock companies to meet the statutory provisions of company law and tax laws. So, whether it is a joint stock company or whether for in case of sole proprietorship as well as partnership firms as well, any form of organization for that matter will have to maintain financial accounting reports because joint stock company will have to maintain the books of accounts as per the requirements of the Companies Act. But when it comes to sole proprietorship and partnership firms, they also will have to maintain the books of accounts, because at the end of the day, they will have to prepare their returns, tax returns. As such, for tax purposes, irrespective whether it is a sole proprietorship or a partnership firm or a joint stock company, it is a requirement to prepare the financial reports. When it comes to management accounting, it is entirely optional, and its forms and contents depend upon the outlook of the management. So there is no set content requirement. There is no a question of any specific format when it comes to management accounting. The way the management needs it, that is the way in which the management accounting reports are prepared. Another difference is that financial statements prepared under financial accounting consist of only monetary information, whereas when it comes to management accounting, in addition to monetary information, non-monetary information is also captured. It need not always be in rupee terms, it can be in the form of units as well. But when it comes to financial accounting, only monetary information has to be recorded in the financial accounts. Then financial accounting follows double entry system, whereas in case of management accounting, there is no such restrictions. Okay, it is not restricted to double entry system. As I told you, the reports are prepared as per the requirements of the management. Another difference is that financial accounting is relatively more precise and less approximations are used. Now, this is because whatever transactions happen, those transactions are recorded in financial accounting data. As such, there is no question of estimations. But when it comes to management accounting, it relies heavily on the data provided by the financial accounting. As such, for its objective data, it relies on financial accounting, takes this data from financial accounting reports, and then interprets it. As such, opinions or interpretations or analysis are done on this financial accounting data and provided to the management for taking decisions. So, management accounting is heavily subjective for planning purposes, and objective data are needed whenever it is relevant. Hence, it is completely dependent on financial accounting for its objective data. Objective data is nothing but factual data. One more difference is financial accounting is independent in nature, whereas management accounting gets its data from financial accounting as well as cost accounting. As such, management accounting is dependent on both financial as well as cost data. So, information that is required to prepare management accounting reports, the data is taken from either financial accounting records or cost accounting records. Another difference is that financial accounting are required to be published and audited by the statutory auditors. So, financial accounting, once it is prepared, it has to be audited by a third party, okay, who looks into the authenticity of the transactions recorded, and then it has to be published. Whereas when it comes to management accounting, since it is only for internal purpose, for the purpose of taking decisions by the management, they need not be published, or there is no requirement for auditing the management accounting records. That's all for now, students. Hope you all had a pleasant learning experience. Please don't forget to like, share, and subscribe the channel. Thank you.